Joining us now is Phillippe Lord, Meritage Homes CEO. Meritage is one of the largest public home builders in the U.S., and the company's stock is up about 70% this year. Phillippe, tell me not just what's happening now, but what you're betting on happening in the next year. You're buying up a bunch of acreage, for example, outside Charlotte. What sorts of homes are you looking to build? What's the demand signal from the consumer showing you?
Good afternoon, and thanks for having me. Rates are stabilizing. It feels like they've moved down around 100 basis points since they kind of peaked out at 8%. And we're expecting, if the rates were to stay stable, that we can continue to see strong housing demand. This is one of the best years we've had in the history of the company. And despite dealing with rates that are almost double what they were the prior 3 years, we're still seeing really, really healthy demand across all of the markets that we build in. So as we sit here today, if rates are to remain where they are or go down, as some people are predicting, we feel like we're going to see a healthy demand into 2024.
How does what you're seeing in labor and materials costs perhaps counterbalance the higher rates and, at least in some pockets, the strain that the consumer's feeling?
Since costs reached the all-time highs that we've seen, our building costs, if you will, last year, they've trended down over the last few quarters, and we're seeing a much lower cost to build, as well as how long it's taking us to build homes. It was taking us close to 6 to 7 months to build homes last year, and right now it's taking more, just around 120 days or 4 months to build homes. And that's allowed us to lower our costs and try to deliver a more affordable product, despite rates being as high as they are. Most importantly, when we can provide what we call move-in ready inventory that's ready to move in the next 30 or 60 days for consumers that need to move now, it allows us to solve a payment for them despite rates being where they are. So we can access the mortgage markets and buy their rate down or secure a longer term rate for them at a lower rate when we have inventory that's ready to move in. And that's really what the opportunity has been for new home builders today versus where it was. With the existing home market being so chronically short due to the lock-in effect, new home builders have the available inventory for these people that need to move today, and we can really solve the payment in a different way despite the rates being as high as they are.
That was exactly where I was going to go with you, and that was the role that incentives are playing in this entire dynamic, as you are talking about robust demand despite higher rates and despite the fact that home prices have been stubbornly high as well.
Yeah, we've always had incentives. That's how we operate. But today, the incentive dollars are really being used to solve the payment for our consumers. We're an affordable builder. Our ASP is in the mid-4s. We build throughout the Southern Hemisphere, and we really focus on trying to deliver affordable product to that first-time home buyer. So it's all about the payment. They used to use incentives for closing costs, or they used incentives to put different features into their homes, or just take a discount on the price of the home. But today, it's really not about the price as much as it is about the rate. If you can move that rate from 7% to something in the 5%, it lowers their monthly payment dramatically more than you could if you were to lower the price of homes. And that's really why the price of homes have stayed relatively sticky. In fact, Zillow reported today that prices are actually up year over year because it's really more about the interest rate and the payment. And as a new home builder and the rest of the industry, we have a way to solve that for our buyers, unlike the existing home market.
So at a time where markets are hyper-focused on when the Fed is going to begin cutting rates next year, what is your outlook for 2024? And as we do have this conversation about prices versus rates and affordability and what that means for the demand piece of the picture, what do you expect?
Well, it's hard to say. I've gotten out of the prediction of interest rate and what the Fed is going to do. But based on the recent reports of inflation and the job market, my projection is that they kind of stick where they are. I think rates are going to stay higher for longer. But I think if they stay stable, it's very easy for us to solve that payment for our consumers. And that's sort of what we're planning our business around. If rates stick around here around 7%, we can solve the rate into a 5.5 or a 5 3/4 rate, which is really a payment that makes sense for our consumer. and we're planning our business around that environment for 2024.